Yo, what's good? This is episode like 6 or 7. Honestly, it is episode like 6 or 7. No bullshit. This video I'm going to be explaining liquidity and where it sits, where stop sits, and why price hunts it. And this video was it was voted on mostly in the poll by the Discord. So, sorry if the chart's a little messy. We are in the middle of a trading week, so alright, let's get started. So, stop losses and why you place them, and somehow price always hits them. Why do my stop losses always get hit? And then goes exactly where I wanted price to go. Why do I get stopped out and then my trade would have hit TP? That's not really necessarily bad luck. That's just how liquidity works. And once you start to understand where liquidity sits and why price hunts it, then you start to view the market a little differently. In this video, I'm mostly going to break down what liquidity actually is, where stops sit, and why price is pretty much designed to take them out. No really complicated terms in this video. Not a lot of bullshit, just straight what you actually need. What you need to know. So liquidity is simple. It's just orders in the market, resting orders, current orders, active orders, but more specifically, liquidity is where a lot of orders are sitting in one place, one price point that can make the market just shift and move to a completely opposite place, or continue going where it was going, but even harder, like a big pump in the market. So your stop loss is an order, technically. When you place your stop loss, it's technically a resting order now. So when a bunch of traders put their stop loss in the same area, that creates liquidity. So if you let's say like a very common A+ setup that a lot of traders would normally take, a lot of the time those get stopped out because a lot of people have their stop losses in the same place, in the same area. So now let's get to the section of the video where stops sit and why retail traders are really predictable. Like I was just saying, they all learn the same thing, so they all place the stops in the same places. Common liquidity zones are usually above highs and below lows, above resistance, below support, and equal highs, equal lows. So you start to notice, was it the last video or the video before that, I was teaching you guys the market structure and how higher lows, higher highs, higher lows, lower highs, or whatever, make the trend. So you see here, liquidity at the top of these highs caused a reversal, complete change in the market. But if we can look at like a higher time frame, not the 5 minute, maybe like the 1 hour. There's a lot of gaps in that price. You see here, this is liquidity. This is also liquidity. Just essentially places that make the market react. That's where you can find resting liquidity and where you can place your take profits or your stop losses. So let's say price forms a high, like this right here. Most traders enter a short somewhere and put their stop loss right above that high. Now what does that really create? A pool of stop losses. A lot of stop losses in a price range, aka liquidity, a liquidity pool, whatever, liquidity sweep, whatever. A lot of people have different terms for it. So why does price actually hunt them? This is the part most people don't really understand. Price doesn't just move randomly the market needs liquidity to move. It needs to take people's orders, either their sells or buys. It needs to move. And that's the way it moves, by taking people out and taking their money. So big players, the banks, institutions, whatever, they can't enter huge positions without orders on the other side. So like, what do they do? They push price into areas where liquidity exists, aka your stop loss. They try to stop you out to take your money and make price go in their favor. That's why you see a lot of reels and stuff, like memes or whatever, talking about what so and so exit liquidity. You're literally Bibi Netanyahu's exit liquidity. You know what I'm saying? Because they just try to take your stop losses out, take those orders, and move completely different areas of where they want price to go. So price moves from liquidity to liquidity. That's how you kind of start to see common price ranges, like you see here. Bottom, high, bottom, high, bottom, high, bottom, high, until it finally breaks out. It's just bouncing in and out liquidity till it sweeps this liquidity down here completely, and the price goes in their favor. So how a liquidity sweep works. Price forms a clear, obvious high. Boom. Clear high here. Okay, NPC. Clear high here. Traders place their stops above it. So if you were to enter a trade off to this short here, let's say you waited for a break of structure right here, you place your stop loss up here, and you targeted liquidity, which would probably be this low here, these liquidity levels down here. You go ahead, you drag, you take profit. Price pushes up, taps those stops, everyone gets stopped out, then it reverses right where your TP was. So it could have been over here. This honestly could have been it. People could have waited for this break of structure here, try to place their stops above this high here, and it taps their stop loss. Any of these wicks here could have tapped them out, and it could have rallied down to their take profit. So right here, you were essentially exit liquidity if you were to enter this trade. So why you keep losing off this liquidity concept, or whatever you'd like to call it? If you're always getting stopped out, it's probably because you're placing your stop where everyone else is stopped, and that doesn't mean you put your stop loss 100 points above what you would normally do it, because that's just dumb. You're just becoming liquidity at that point, and the market is designed to take liquidity. You're meant to lose in this market. You're meant to lose. So instead of being that person getting stopped out, you want to start thinking like this: where are people trapped? Where are stops sitting? Where would price go to grab liquidity? So now that you understand how liquidity works, I just kind of broke it down a little bit where resting liquidity would be and whatnot. Now you know where most people would place their stops. Because once liquidity gets taken out, then that's where the real move starts. And that's usually also the whole concept of accumulation, manipulation, and distribution. If here, I think I have yeah, there we go. So let's look for a good example for this. Here we go. This is good. So you start to see here accumulation, which I taught in the the market structure video. Accumulation, same thing as a consolidation, just going back and forth. Manipulation, manipulated everybody to the downside. Everybody was like, we're gonna sell. So manipulated everybody, and then boom, distributed and broke out. So you would have been exit liquidity here because you would have got manipulated, would have tapped your stop. Your stop loss would have probably been up here or right here. You would have got stopped out in this move, and then bink, distributed up. I'm sorry, I'm sick right now. Like, my allergies are so bad. So an example setup would be wait for price to break above, take liquidity somewhere, then show rejection, like I just showed. That's where smarter entries come in. So now you know accumulation, and then you see a big move. So usually accumulation is before New York Open happens or Asia Open, something like that. And then you see a manipulation to the upside or the downside, which most people would be like, okay, that's where this session is headed. It's headed to equal highs, daily highs, weekly highs, whatever, session highs, and then boom, you get stopped out, and it reverses completely to the opposite way, or the way you want it to go. So once you realize this market isn't really random at all, it has more often patterns and how could you say this? Patterns and yeah, whatever. I can't even think right now. It's just a game of taking money, essentially, from people who don't understand where they're placing their stops or what they're doing. So people are just really exit liquidity for BB Yahoo. And let me think if there's anything else I should get over. I think honestly that's it for liquidity. So summary, liquidity is just resting orders, resting buys, resting sells, resting stop losses. And you can spot liquidity really easy when you just see the market shift. Where the market shifts, you see, okay, a lot of orders were filled, that's a lot of resting liquidity, and that caused the market to shift. And where you see a really like A+ setup trade that you would take, you would place your stop loss where a lot of other people are placing their stop losses. So it's going to hunt your stop loss, and you're going to lose, and then it's going to go where you want it to go. And I think that's everything for this video. If you got any questions, you already know I'm active in the Discord every day. Comment below, whatever you need, I got y'all.